Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Richard Johnson, CEO of Texture Capital, to discuss how recent innovations in DeFi have demonstrated the potential for tokenized solutions to provide a better market structure. Richard, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Good to see you.
For some background, let's start with a Wall Street Bets trade, GME, of course. Explain to the audience what shorting refers to, how short interest exceeded 100% of shares outstanding, and why it led to what's referred to as a short squeeze.
Sure. So shorting is generally a good thing for the market. It allows people, investors, to express their opinion about a stock on the downside. So in that regard, if people think that a stock is going to go down, they'll sell it short. So what that means is they'll borrow stock from somebody else, sell it in a market at one price, and then hope to buy it back later at a lower price, thereby capturing that profit. Generally, it gets criticized a lot, but short selling is considered good because it improves liquidity and brings more participants into the market and leads to better price discovery. What happened with GME was quite strange and unusual, but what's called short interest got to 140% in the name. Basically, what that means is that people were selling short 140% of the market cap of GameStop. Now, that shouldn't be possible. How can you sell more than the company that actually exists? And the SEC has put in regulations to try and prevent that happening, but there are some weaknesses in the plumbing of the markets. What happened was, what happens in the market, I described, an owner of the stocks lends it to somebody else who sells it short in the market. But what then happens is the person who bought it can then lend it out again, and then it can get shorted again. So the same stock can get shorted 2 or even 3 or more times in the market. So you average that out with GameStop, because there was a lot of people shorting it, it increased up to 140%.
And the GME trade forced many online brokers to prevent their customers from trading in other affected securities. And many folks decry this as unfair discrimination of smaller retail traders to protect the hedge fund fat cats, if you will. But in reality, this has nothing to do with class warfare. Tell us more about that.
Yeah, so well, let me finish on the short side there. So what I think we can do with tokenization around shorts, and I think when I say tokenization, I'm referring to using blockchain technologies to tokenize digital securities. And that has massive advantages, because then you've got a distributed ledger, which all participants in the market have a copy of. So you could never have that same stock being shorted twice. So that's why I'm saying that tokenization can prevent this kind of short selling. The other problem that happened with GameStop was that, as you said, some brokers cut off their participants from trading in the name. The reason they did that is because stocks settle on a 2-day settlement cycle. So you buy the stock on a Monday, it doesn't settle till Wednesday. And everything in public equity settles through the DTCC. It's the central clearing agency. And there's some risk that, so people can buy something on Monday, they don't have to pay for it till Wednesday. So there's a risk there that it doesn't settle. And to manage that risk, the DTCC makes all its brokers put up collateral requirements. Now that collateral is based on the quantity outstanding and the volatility of the stock. Obviously, GME was very volatile at the time, and there's a lot of trading activity. So the collateral requirements went up massively. Robinhood and many others just didn't have enough capital on hand to post to cover clearing over the 2-day cycle. So the best thing they could do was cut off trading, certainly at least the buying. Selling actually improved their position. And what I'm saying is, in a blog we put out recently, is that we've got an answer for that as well with tokenization, because what you can do is you can have, if you have tokenized cash on the blockchain, sometimes called a stable coin, you can have the security and the cash settling in real time, delivery versus payment instantaneously. So it's called real-time gross settlement. And that would mean there wouldn't be any 2-day settlement cycle, and there wouldn't be any collateral requirements. There's another way that tokenized securities can improve market structure.
And Richard, the question is retrofitting today's public equity markets a viable solution? Can this actually be implemented?
Well, it's a good question. A lot of people have been trying it. It's very difficult. One example is the chess system in Australia by the Australian Stock Exchange. They started working on a project to do just that in 2016. And they just came out recently, they're extending it for another 2 years. It's still not delivered. It's very difficult ripping out one set of plumbing and replacing it with another. There's another firm in the US trying it called Paxos. They've got a good solution, but they've got a long way to go on that. So I think it's going to be a long time before you can do that in public markets. At Texture Capital, we're very focused on private markets where you don't have some of the existing plumbing. You don't even have a DTCC. So we feel that we can really showcase the benefits of this technology, and hopefully one day we'll be able to kind of implement it in public markets.
All right, Richard, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.